In the morning. That's a look at your headlines. Now, here's Mike.
Thank you, Sarah. At the closing bell yesterday, the Dow rose 50 points, ended the day at 14,447. The S&P 500 edged up just over 5 points. That index, by the way, the most popular market measure for investment funds, just 9 points shy of its all-time high in October 2007. So if you're scoring at home, that's 7 straight days of gains on Wall Street, which belies the struggle for our economy, which is in its historic highs for the market. And if they've gotten your attention, here's some tips now to follow up on what you should maybe jump in on if you're ready to do that. Here to offer some of those do's and don'ts on Money Tuesday is Stuart Welch of the Welch Group. Stuart, great to see you this morning.
Good morning.
Hey, let's talk about that. Now, people who may be wanting to jump in on the market now because they see it's going up, talk about some of the do's now, and you talk about rebalancing. What do you mean by that?
Well, rebalance. First thing, you want to set up a target portfolio, the target between stocks and bonds, and then targets within your stocks and targets within your bonds.
Okay.
And if you started today, 12 months from now, that target's going to get out of whack. Some things have gone up, some things may have gone down. And rebalancing is a process. It forces you to take gains on things that are doing well and put it on things that maybe are not doing as well, under the assumption that over time, those things that are underperforming are going to begin to do much better.
Okay, that makes a lot of sense. Of course, there's risk involved. This kind of follows up on what you were just talking about. How do you guard against that?
Well, I think a lot of people are worried about the market, jumping in right now because the market is at an all-time high. And one way to do that is to begin to dollar cost average. So if you have money, instead of putting it all in at one time, put it in a little bit each month, and that'll help mitigate the risk in the market.
So when the stocks are down, you're buying, even when it's down, you're buying high.
Well, when the stocks are down, you're buying more shares,
Gotcha.
so you're in a better position.
All right, in terms of retirement, you're saying people aren't doing enough, are they?
Well, I think one of the do's is to put more money, increase your allocation, because what we're finding is virtually almost everyone is underfunding their retirement. So put more money in.
All right, when we're having this bull market, there are some things that you should not do, and one you said is don't fight the Fed. What do you mean by that?
Well, the Fed has had easy money policy. They've had policies in place to keep interest rates down, and interest rates are good for the stock market. In fact, it's forcing people, interest rates are so low, it's forcing people into the stock market. So don't fight the Fed, run with them, and right now they're very bullish on stocks.
I know it's just your opinion. You think the Fed's going to change much?
Well, the Fed has indicated they're going to keep rates low for at least 2 years, so you got a long way to go.
All right, also, obviously when we have a downturn, it could happen today as a matter of fact, knee-jerk reactions are bad, right?
Well, and I think that the market is going to settle. We've had 4 years of a bull market. It is going to fall back at some point. Don't use that as an opportunity to say, that's it, I'm getting out of the market. Realize that is part of the process.
All right, and finally, love thy neighbor? Maybe it's not so much, right?
Well, I think my point here is don't take advice from your neighbor, or at least think about who you're taking advice from. You either want to develop your own investment philosophy, or I'd suggest you hire a pro, one of the two.
Right. Don't listen to your neighbor if he's got a stock pick. Bad idea.
Yeah.
Usually.
Yeah, usually it's a bad idea.
Stuart Welch, thanks so much.
Thanks, Mike.
Good tip.